All right, so today we're diving into those high-yield dividend stocks.
Oh, yeah.
You know, the ones
The juicy ones.
that offer that stream of passive income.
Yes.
And today we're zeroing in on AGNC Investment.
Okay.
We got an article sent in by a listener from Motley Fool
Right.
from January 31st of this year, asking about whether they can actually keep up their
Yeah.
pretty amazing 14.5% dividend yield.
Wow. Yeah, that's
That's got to raise some eyebrows, right?
it certainly does. I mean, 14.5%
Yeah.
is way higher than the average you see for most stocks.
Right.
And so that does lead to the question,
Yeah.
is this too good to be true?
Okay, so let's break down what AGNC Investment actually does and how they actually get those returns.
Yeah.
I know they're a mortgage REIT, but can you remind us what that actually means?
Yeah, it's easy to get lost in the jargon.
Yes, it is.
So basically, a mortgage REIT
Yeah.
is a company that invests in mortgages.
Okay.
And they do that either by owning them directly or by investing in these mortgage-backed securities.
Gotcha.
And the way they make money is they leverage
Yeah.
the difference between short-term and long-term interest rates.
Interesting.
So they borrow money
Yeah.
at lower short-term rates,
Okay.
and then they use that money to invest
Yeah.
in mortgages that pay out higher long-term rates.
So they're kind of playing the spread.
Exactly.
They're like a financial middleman.
Yeah, like a middleman.
Okay, so this Motley Fool article points out that AGNC isn't doing so well, like on the surface.
Okay.
They recorded a loss last quarter, and for the whole year, doesn't sound like a company that can afford to pay out
Right.
a 14.5% dividend.
That's where things get interesting.
Okay.
So this is something you'll want to pay attention to.
All right, I'm listening.
See, AGNC, they focus on long-term portfolio returns
Okay.
rather than just the short-term gains.
Interesting.
So their argument is that as long as they're generating
Yeah.
a high enough return on equity, or ROE,
Right, ROE.
they can sustain that dividend.
Hold on, wait a second. I know ROE is important.
Yes.
But remind me, why is that the key metric here?
So think of ROE as like the ultimate measure
Okay.
of a company's profitability.
Okay.
It tells us how well
Yeah.
they're using their equity to generate those profits.
Right.
So for AGNC, the magic number is 16.7%.
16.7%.
That's their current cost of capital.
Okay.
So basically the return they need to hit
Yeah.
to cover all their costs, including those dividend payouts.
So if their ROE dips below 16.7%,
Yes,
that massive dividend's in danger.
you got it.
Okay.
Now, the good news is
Yeah.
they're currently generating ROEs between 17 and 18.5%.
Okay.
So at the moment, they're clearing that hurdle.
Phew, that's a relief.
And then some.
But are they just like barely scraping by, or are they confident about the future?
The CEO seems pretty optimistic, actually.
Oh, okay.
The article mentions a few reasons for this.
Like what?
So the Federal Reserve is lowering interest rates.
Oh, okay.
Inflation is declining. And he sees a good investment climate ahead.
Okay.
All those factors
Yeah.
could lead to more opportunities for AGNC
Right.
to make those profitable investments.
So it sounds like they're betting on
Yeah.
a few external factors working out for them. But let's be realistic here.
Okay.
Is a 14.5% dividend yield
Yeah.
something investors can really count on long term?
That's the million-dollar question, isn't it?
Yeah.
And to answer that, we need to dig a little deeper
Okay.
into their strategy and the risks involved.
Let's do it. So we're back and still trying to figure out if AGNC Investment can really keep this high yield dividend thing going.
Right.
Now, something I find a little strange is how they're reporting these losses, but still saying they can afford this payout. What's going on there?
Yeah, that's one of the tricky things about mortgage REITs that you really got to understand.
Okay.
So remember, they're dealing with these mortgage-backed security, and those values can change a lot in the short term.
Yeah.
So what you might be seeing are what are called paper losses.
Okay.
They're unrealized losses that haven't really been locked in
Okay.
because they haven't sold those assets yet.
Oh, so it's kind of like checking your stock portfolio after the market dips, you know?
Yeah.
It looks bad.
It looks scary.
But as long as you don't sell anything, you haven't actually lost money.
You got it. It's all about the long game.
Okay.
AGNC believes the value of their mortgage portfolio will eventually recover, and those paper losses will turn into real gains.
But that brings us to some of the risks
It does.
we should consider.
Yeah.
The article mentions AGNC is really sensitive
Yes, very much so.
to interest rate changes.
Yes.
How worried should investors be about that?
It's a big one.
Okay.
It's a major factor to keep in mind.
Okay.
So remember how mortgage REITs make money?
Yeah, they play the spread.
Right, from that spread between short-term and long-term interest rates.
Right.
Well, if interest rates jump up unexpectedly, it can really squeeze that spread.
Yeah.
And that hits their profitability.
Yeah.
And could hurt their ability to keep paying that dividend.
And of course, they use leverage to get bigger returns.
Yeah.
But that also makes the risks bigger.
Exactly. Higher risk, higher reward.
Are there other risks
there are
that investors need to know about?
So another one to watch out for is prepayment risk.
Okay.
So if interest rates fall a lot, homeowners are more likely to refinance their mortgages.
Oh, I see.
And when that happens, AGNC's investments might be paid back sooner than they expected.
Interesting.
Which can mess with their cash flow and their ability to reinvest at good rates.
So they're working a tightrope.
They are.
Between interest rates being too high and interest rates being too low.
It's a balancing act, for sure.
What else should we be thinking about?
Well, it's important to remember that AGNC mainly invests in agency mortgage-backed securities.
Okay.
Now, these are seen as safer because they're backed by, government-sponsored enterprises.
Right, like Fannie Mae and Freddie Mac.
Exactly.
Okay.
However, that also means their returns might be a bit lower compared to riskier non-agency mortgage-backed securities.
So it's that classic lower risk, lower reward.
Right.
So for someone interested in AGNC and that tempting 14.5% yield, what's the best way to track how they're doing?
Transparency is key.
Okay.
AGNC's financial reports, they're all publicly available.
Okay, good.
Keep a close eye on their ROE.
Okay.
And make sure it stays above that 16.7% cost of capital.
Yeah, the number we talked about.
Exactly. Because if it dips below that, that dividend could be at risk.
So those ROE numbers are really important.
They are the canary in the coal mine.
What else should investors be watching?
Well, you got to stay informed about what's happening in the whole mortgage market.
Okay.
What are interest rates doing?
Yeah.
Are prepayment rates going up? Are there any new regulations coming that could impact their business?
Sounds like there's a lot to keep track of.
There is.
But, if that 14.5% payout is stable, it may be worth it.
That's up to each investor.
Sure.
But I think the main thing here is that a high dividend yield, while attractive, shouldn't be the only thing that makes you decide.
Okay.
You got to understand the business.
Yeah.
The risks and how it fits with your own investment goals.
Right.
And how much risk you're willing to take.
You've given us a lot to think about.
I hope so.
But before we wrap things up, I want to get your personal take.
Okay.
What stood out to you as the most interesting or surprising thing about AGNC?
Well,
so we've learned a lot about AGNC investment.
We have.
And it's been a really cool look into mortgage REITs and these high-yield dividends.
For sure.
But let's get to what everyone wants to know.
Okay.
Should you actually think about adding this to your portfolio?
That's the big question, right?
Yeah.
And there's no easy answer.
Right.
It really depends on you.
Okay.
Your goals, your risk tolerance, your whole financial picture.
Because a 14.5% yield could be amazing for some investors.
Right.
But for others, it might seem like a red flag.
Exactly.
So if you're someone who wants that steady passive income and you're okay with the ups and downs of mortgage REITs, then AGNC might be worth looking into.
It might.
But if you're more focused on your investments growing in value or you don't like taking big risks, there might be better choices out there.
There could be.
It sounds like AGNC is kind of high risk, high reward.
It can be.
So I'm curious, after all this research, does that 14.5% tempt you?
That's a good question.
To consider AGNC for yourself?
For me, what I've learned from all this isn't so much about whether to invest in AGNC or not. It's more about how to look at any investment with a healthy bit of skepticism and really do your research. Never invest in something you don't fully get or that doesn't fit your financial goals.
Absolutely. Couldn't agree more. And that's something we always say here on the Deep Dive.
For sure.
Do your homework, folks.
Yes.
And if you're not sure, talk to a financial advisor.
Right. Get some advice.
Someone who can really help you figure things out.
Exactly.
But before we let you go, one last question.
Okay.
What was the most surprising or interesting thing you learned about AGNC?
I think the most surprising thing for me was how focused they are on the long term.
Interesting.
The fact that they're willing to take those short-term hits to get those long-term returns really shows their whole investing philosophy.
Yeah, it's a different way of thinking.
It is.
Compared to that short-term focus.
Yeah.
You see a lot in the market.
A lot of that going around.
Definitely.
It really highlights, you got to look beyond the headlines and understand a company strategy before you jump in.
Couldn't agree more. Well, we hope you enjoyed this deep dive into AGNC Investment.
It's been fun.
It's a complicated company.
It is.
In a complicated market.
Sure.
But hopefully you got some good insights you can use on your own investing journey.
Definitely.
Remember, knowledge is power.
It is.
And the more you know about the companies you're investing in, the better choices you'll make.
Absolutely.
So until next time, keep exploring, keep learning, and keep diving deep.